On today, we have myself, Megan Beekman, Janice Fowler, and Josh. And how do you pronounce your last name, Josh?
Donahue.
Donahue. So I will start off letting Josh talk a little bit about what he does at Audrys Barnyard.
Good morning. So we do 5 things essentially. We offer pet boarding for dogs and cats, dog daycare. We do grooming also for dogs and cats. We do dog training, and then we also have a retail store. We are right in the heritage area of Wake Forest, and we have been there for almost 3 years now. So it's been a crazy ride. Is this where you wanted me to talk about the pet moving stuff, or do you want me to do that a little bit later?
No, you can now.
No,
Yeah.
fine. Yeah.
Oh, okay. So one of the, I think, things that I can offer to this conversation you guys are having today is the area that we are in, as you both know, is growing crazy fast. And almost probably every day, or at least every other day, I have somebody calling or emailing that's moving to the area, trying to find something to do with their pets. They're nervous about their pets because, as most people that have moved know, you have people opening the door left and right. And I personally have lost a pet. When I moved to Florida years ago, my cat was able to escape and get away. And it creates a lot of stress for the pets. And that starts all the way in the beginning. When you start packing boxes, they get a little stressed out. And I've noticed a lot in my business when some of my regulars that come for dog daycare are acting out a little bit. And I ask the mom and dad, is anything happening at home? It's almost amazing to me how often the answer is, well, we're packing up, we're getting ready to move. And I can see it from the animals. They're stressed out and they're acting very, very differently from what they normally do. So we have a lot of clients that will reach out to us and ask to board their pets with us while they're going through the process of packing up if they're moving away. Or we've had a lot of people that'll have their pets transported to us ahead of the move. One lady in particular that moved from Colorado a few months ago had a professional pet service deliver all 4 of her animals. And they stayed with me for about 2 weeks while she got in the house, got everything set up. So now when they got into their home, finally brought the pets in, it was like a home. It wasn't just boxes everywhere. It was a much more smooth transition for them. And it went very well for her. And I honestly, until then, didn't even know there was professional pet services. It would drive your dog all the way across the country for you. So I have no idea what that cost would be, but the idea behind it was really good and it made it a much smoother transition for her animals. And for her, like a lot of people, those are her babies. Those are her kids. But it is amazing to me how high the stress level can get on the pets from the time you start packing up boxes to the time you finally, unpack. And the level of risk with people, movers going in and out of the house and your family members coming in and out of the house is very high. So that's one big part of our service for boarding that gets used. I always just kind of thought it would just be people going to Disney World that would be using us or going on vacation. But we do have a lot of people that use us when they're moving just to reduce the level of stress. And then obviously all the other parts of the business, the grooming and stuff is all great. But in this conversation that you guys are having today, I think the pet boarding is where our business can really be of help to you guys.
Yeah, I think so too. Okay, thank you.
Yeah, thanks. That was awesome. All right, so I'm going to go a little into the different costs that can come up when you do move. Some things you don't think about, and not too in depth, but just some things to prepare for. So that way, when you start looking into buying and going through that process, these expenses don't come up and throw you off, and you get crazy surprised by what's going on. So as far as taxes, money, different deposits that you're going to make, appraisals, inspections, things like that. So the first one is the excise tax or transfer tax. So in North Carolina, when you transfer a property, there's a tax. Generally, this is covered by the seller. So as a buyer, it's not really a main concern, but it's $1 per $500 of the value on the property. So this tax generally, again, is one of the seller's expenses that will be totaled up when the closing costs come up. Another cost is earnest money, and this one is a pretty important cost that you'll discuss earlier on when you were writing an offer. So when we put together an offer, once we find a property that you're interested in and want to put in an offer, you're gonna figure out what price you want to offer for purchase price, and then you're gonna figure out what earnest money deposit you want to do, and then you also want to figure out what due diligence. So your earnest money kind of shows the seller that, hey, like I have this money to set aside for closing costs, and it kind of shows them that you are serious about your offer. So when you put in this, when you set your earnest money, we will, after they accept our offer, that amount that you set, whether it's $2,000 or $3,000, I'll get a check from you, and I will take that to the attorney's office, and they will hold on to that until closing. We'll get a receipt for that and document all of that, but that'll set aside money to cover the cost of closing. The next is due diligence, and like I said, this is one of those that you're going to discuss when you are putting in the offer. So your due diligence puts a little bit of skin in the game for you, because during this due diligence period, you do your inspections. You can back out without any consequence other than losing your due diligence fee. So some people do $500, some people do $2,500. It kind of depends on what you can afford to lose, because if something were to come back in the inspection and you wanted to back out of the property, the seller would get to keep this money. And the reason for that is, if you just put in offers on houses and then back out, the seller has to go back. They have to relist their property. They have to do showings again. They have to do open houses and go through that whole process. So this shows the seller, hey, I'm serious. I'm interested in buying this property, and like, I'm going to put this money on the line. So when I discuss this with buyers, my main question is, all right, well, what are you willing to lose if something comes back and you want to back out? Or, you lose your job and you want to back out. You decide you actually want to move to California and you want to back out. For whatever reason, you can back out during that due diligence period, but that the seller will keep the due diligence money. And so once we do go under contract, I will get a check from you with the amount of the due diligence that we agree upon, and I will give that to the seller's agent or the seller. And then that will also go towards closing costs once we get to the closing table. Other fees to think about are inspections. Most properties, you do a home inspection, especially just to see, if there's any issues with the property as far as plumbing, electrical, and things that you want to request for the seller to have fixed before you move in. So this is just a small list of inspections that you can have done. Most people do just a general home inspection, a radon inspection, and maybe a pest inspection, but it really depends on the property that you end up going with. So, say you find a couple acres, you might want a survey so that you know exactly where your land is. Radon is something that not a lot of people are familiar with, but it's a gas that you can't smell. So it's generally in more rocky areas. So depending on where you are, it could be an issue, and it is a deadly gas. So it's generally better if you check for it, make sure it's not an issue before you move in. That way, you're safe and you're not going to die from radon. So this is just a list of inspections that you want to kind of plan ahead and think about what inspections you might want when you buy a home. Another thing is appraisal, and I probably will let Janice touch a little bit about this, but if you're going to finance your home, the mortgage lender is going to want to do an appraisal so that they are only lending a specific amount depending on how much the house is worth. So if you're buying a house with a cash offer, you don't necessarily have to have an appraisal unless you personally want to see what it's worth. But this is a cost that goes through the lender. Janice, is there anything you want to touch on it now, or?
I'll hit on it later.
Okay, sounds good.
Okay.
And then your escrow account, initial escrow account, excuse me. Janice probably will also touch on this a little bit, but this goes towards taxes for the following year, and I'll let her go more in depth on that as well. Another thing is title insurance. So it's a one-time purchase. That is something that you will have come up when you go to buy a house, the transfer of that title. And then other settlement fees, and that will be through the attorney's office. So depending on where you go, those fees can range and depend on, you know, what's in the transaction, what they would be. And then just some other costs to think about when you're buying a house is, you know, moving expenses. Are you going to rent a truck? Are you going to pay movers? Are you doing it yourself? You know, do you need supplies? Do you need to buy blankets, packaging tape, boxes? Things like that are like last minute expenses. I think that, you know, you're like, oh no, we have to move next Saturday. We need to rent a truck. We need to wear the boxes. So these are some things to think about ahead of time. Maybe, you know, set aside a couple $100s for the moving truck, just to have it planned in your mind so that once you move, you're not stressed about, okay, I didn't expect all of these expenses to come up. Another is if you're maybe moving to a bigger house, then you're going to want to buy furniture for that house. And maybe you went from, you know, a 1-bedroom or 2-bedroom apartment, and now you have 4 bedrooms to furnish. So that's another expense that you want to kind of plan ahead is like, okay, well, we might need to buy new furniture. And obviously you don't have to do it initially, but it's just something to kind of start to think about. As well as any types of repairs. If you want to paint once you get in, you know, if they painted the sunroom yellow and you really would rather it be blue, it's, you know, not a big expense, but it's just nice to know and have it like planned ahead for that. And then pet care, that's where Josh comes in. You know, if you need any tools to fix up your house, you know, once you move into a house, there's all kinds of different things that you might want to do, or now you have a garage where you can go out and do woodworking. So just different things as well as renovations. Those are some of the costs that may come up. So if you guys have any questions, feel free to put them in the questions and answer box. But I will switch this over to Janice. Let me pull up her slides. Alrighty.
Yay. You get to do the hard stuff. So glad. Okay, this actually just a disclaimer. Just to remind you, I'm Janice Fowler. I'm with Perennial Mortgage Group, and I want to reach out and say thank you to Josh for coming and discussing his business with us, because it's a good complement for what we do in loans as well, you know, on financing homes as well as when someone is purchasing, because I have 2 pets, I have 2 dogs, and I know that moving day is terribly stressful for them. So for me, it was when I first talked to Josh about it, it was just such a great benefit that, you know, could be able to take my dogs over on moving day and know that they're safe and taken care of. So I really appreciate you showing up. Wanted to discuss today, in our last discussion, we went over some of the costs and again, Megan touched base on it. But I wanted to discuss some of the programs a little more in depth. We got some questions afterwards and people concerned about the percentages. So basically in loans, you have 2 general types. You have a lot of different loans, but you have 2 basic types. You have a conventional loan, which we all know about, that the average down payment or the minimum down payment on that is 5%. Now, conventional also has their own first-time home buyers program. So within that first-time home buyers program, there's actually 3 different types of programs, Fannie, Freddie, and then another type within there that will actually allow you to only have to put 3% down. So that gives you 97% financing. Government loans are loans that are actually backed by the government that cover that additional percentage the lender doesn't want to lend. Generally speaking, lenders are comfortable with the risks that's associated with 80% financing. So anytime they're financing more than that 85%, you get either rate increases or you get the mortgage insurance, you know, various things like that that are proportionate to your increase. So if you're at 85% financing, you're going to have less of an increase than if you were at 80, then you were at 90 and 95. And USDA, FHA, and VA are all government loans that are the government securitizes or guarantees that difference. And so that helps in the cost, supposedly. So we're going to talk about these a little more in detail. And then that's the next. Okay, so conventional loans, again, they require 5% down. If you can put down 20%, if you're in a position to put down 20% or more into your loan, that's your best way to go, because you're going to get the best rate, you're going to get the best financing, the lowest payment, and in most cases, you'll find this is, this is probably going to be your best direction to go. However, on all loans, you should be comparing all of them at the same time and looking to make sure you got the best one. Anytime, again, there's financing over that 20%, you're going to have something that's called PMI factor that's based on where your credit score is, how much over that percentage you're buying, and things like that. So there will be MI, PMI, whatever you want to refer to it as, within the conventional loans if you're financing over that. So this compares to the government loans. So we have government loans. The first one is USDA loan. Now, USDA loan will allow 100% financing, but a couple of the features of it. USDA loan has mortgage insurance that is on it for the life of the loan. Conventional loan, when you have mortgage insurance and it pays down to 80%, say you finance 95%, now you're at 80%, you can pick up the phone and call your lender and say, hey, I want the mortgage insurance removed, and they can take it off at 80%. You don't pick up the phone and call them, it's going to stay on there till it hits 78, and then it's mandatory it comes off. But for USDA loans, it's there for the life of the loan. So whatever percentage they're charging, so that's one thing you need to keep in mind. USDA loan also has what's called an upfront funding fee. They have a one-time charge when you're financing the loan. If you're getting 100% financing on a $100,000 house, you're going to have a $100,000 loan, and then your 1% of that loan is going to be added on that. So you're going to be actually financing $101,000 on your $100,000 house. You can also pay that outside. But this is a mandatory fee. It's 1% of the loan amount. And then you also have an annual mortgage insurance charge that is 0.35 times the loan balance. So that's how that is calculated. And whenever you're doing comparisons of one product to another, these are all the things you're looking at to make sure that that's where you want to go. Two other things with USDA loan. USDA loan is more created for rural. It's for people who are making a little less money. They're not working on Wall Street bringing in the big bucks, and they're living a little bit further outside the city. So USDA is qualified by the property address. And if say you're in a general area, maybe you're looking at Four Oaks, Garner, different areas, and if you can call and give me the zip code, I can kind of give you an idea. But what I really need is the property address, and I can tell you if that particular property is eligible for USDA financing. And the other thing that must qualify is going to be your income. Your income needs to be at or below 80% of the median income for that geographic area. So if you have a specific address, again, I plug that in. I know what your income is. It says, hey, 80% happens to be $80,750. As long as you're making less than $80,750 a year, then you would qualify to go ahead and utilize that program. So there, again, that's some of the factors there. FHA compares in that it requires 96.5% financing. They will allow you 3.5% down. FHA also has an upfront funding fee. Their upfront funding fee is 1.75 times the loan amount. And they also have annual mortgage insurance premium. If you're financing 95% into a loan, your mortgage insurance premium is going to be 0.85. That's the factor that's going to be applied times your loan balance. If you go down to 90, I believe that adjusts down to 0.8. So again, it works just like the other in conforming loans. It's based on the percentage you are over and above that, that percent. But there are two different things. Now the FHA, and also we can go to the VA because it kind of looks like this also. The VA and the FHA are a lot alike except, I guess for their uses. VA is structured for veterans. The idea for them is to give them 100% financing, help somebody, achieve what they need to do. And you get a VA benefit. And the VA loan, the government allows a 20%, they insure basically that 20% difference. And that's what keeps you from going way up on the rate. VA loans and FHA tend to have better rates. But again, your cost is also a factor, and you need to look at that over the course of the loan. But in many cases, I've had people come to me and we've looked at, they qualify for VA Advantage. They want to, they want to look at that. But when you look at all the numbers and you look at the rates, you are much better off to go up in that particular scenario with a conforming loan. So and if you do qualify for a VA loan, by all means, you should look at it. But do not go in with the mindset, this is the way I got to go because it's the best way. You want to make sure you look the best at the different programs and make sure that is the way you want to go. Okay, the other thing we want to elaborate on is we talked about closing cost and prepaids, and everybody wants to know first and foremost, what's this going to cost me? For general ballpark numbers, what we said, if you're looking at, there's two different sides to what you're paying. There's the absolute closing cost, and then there's prepaid items, things that just are required to be paid by the lender. For a ballpark number, just to throw out there when you're running your calculations, if you figure $3,000 for closing cost and $3,000 for prepaids, you got it covered. But what the difference is, and I'm going to show you this to break this down. Closing cost includes, go to the next one. The closing cost includes application fee, which processing fee. Usually those two things are a fixed amount and are fixed no matter who you're dealing with, who the lender is working with. Appraisal costs, again, the range can go from $450 to even $575, $600, depending on the ones that get to be $600 are usually, you know, $500,000-$600,000 house with quite a bit of square footage. So it's proportionate to that. About the average is $450, $500. Credit report, you're going to have that. Now, when you're quoted these things on your loan estimate, you're trying to quote as closely as possible, but we're also trying to quote higher because we can't quote lower. So when you see these, like on the credit report, when I quote that to someone, I'm using a number for $50. Normally that runs about $36. So when your initial numbers and what you end up closing with usually end up fairly close, but there is some adjustment and hopefully you end up less. Flood certification is just maybe $9 or $10. Settlement and attorney fees are what they charge. May run you, again, depending on the attorney, anywhere from $750 to $1,100, depending on the attorney. Title insurance and title search. Title search is, these have to be done. They're required when you're doing a loan. The idea of a title search, it goes back 30 years on your property, and it looks at any ownership, anybody who has had any claims on that land going back 30 years. And the reason they do this is so you don't close and buy a house and then have someone great niece to drop in and say, I'm sorry, I really own this house, and force you to move. So they go back 30 years to verify there are no encumbrances and no claims on your property. And that's a very important thing for you to have. And then once that's done, they're really going to put an insurance there to insure the property. So it doesn't insure the property, but it insures the search against claims and defects. Recording fees, little things like how many pages are in your deed and in your title when the attorney goes to record it. That's what that is. Funding fees and discount points. Remember we talked about the upfront fees that could be charged. That's where you would see that charge. You would see it as a funding fee, or you might, there's another call, an MI, upfront MI fee, might be labeled something different. Discount points are things that you pay, that you elect to pay to buy your rate down. So again, if today's rate, and it doesn't cost you anything and you don't get any credit, but if today's rate is 3.375, but you really want that rate of 3 1/8, 3.125, it may cost you to buy that down, and it may cost you $1,000, whatever it is. That's going to be disclosed and shown on your estimate as well, and it will show up as a discount point there. Things that you can elect to have, and Megan touched base on this, surveys of the property. You might want to get your own survey to make sure the last one was accurate. Property inspections. I believe FHA actually requires, if you go with them, FHA requires that you do a well, septic, and water test as part of their program. And these are not all inclusive. I mean, pretty much is inclusive, but depending on what your individual scenario might call for something else that you need done. Maybe you have roof issues that you noticed when you looked at the house, in which case you probably you might want to look at that, do an inspection for that. So these are all things that you can see. The prepaid cost, again, we said it's different from the closing cost. The prepaid cost, when you get ready to close, your lender, again, is going to insure their risk. They want to make sure that nobody's going to come back in the next year and have a claim on your property. So one of the things they require to protect the property is 1 year of homeowner's insurance in place. That's included into the loan. It is required, and it is part of the prepaid items. It's something that is for you, but it's being paid in advance for you. If, let's say, property taxes, they come out due in September, and you buy your house and you close in October and they haven't been paid, the property taxes are going to need to be paid. So that in that space, it would account for that. Now, the seller's responsible for anything up to the date of closing, so that's not anything to panic of. But again, that's where you're going to see that. And if there were, we talked about the MI discount points and all MI premiums, you may see that as well there. Don't see that too often. The other thing that's part of your prepaid cost is when you go to establish your escrow account. At the end of the year, you need to pay, you're going to need to pay another whole year of homeowners insurance. It's going to come due. And you're also going to need to pay those property taxes. And the two things can get to be pretty expensive. So you want to make sure that is done and you're not getting hit with it one at a time. Well, when you make your payments each month, it's calculated into your monthly payment amount. A portion of that goes to principal and interest to cover your loan, but the other portion goes into your escrow account where it sits to cover your taxes and insurance. And then when those are due, a notice is sent out and the bank or the lender, whoever's handling it, automatically pays that for you. So when you go to close, you need to make sure that you have the money in there so that at the end of the year, it will need to be that you will have money to take care of. So they will set aside an initial, usually it's about 2 months, sometimes it can be 3, of whatever your monthly homeowner's insurance is. And they can also set aside property taxes. And property taxes really is going to be based on the month you closed, based on what's due. So if you closed in February, taxes come due in September. So you'd have September, October, November, December, January, and February. You would need to probably set aside about 6 months of property taxes. And that's closing cost and prepaids in a nutshell.
Well, thank you guys for coming on. If you have any questions, please put them in the Q&A or feel free to email us or call us. We'd be happy to answer any questions or find the answer if we don't have it. But that is all that we have for today. And I appreciate you guys jumping on here. And thank you, Josh, as well for coming on.
Thank you for the invite. I appreciate it.
Absolutely.
Thank you.